Something extraordinary just happened. In the middle of the most violent correction in precious metals history, in the middle of a crash that wiped out 21% of gold's value in 2 days, Wall Street just doubled down. The biggest banks in the world just looked at the carnage and said, "We are buying more." Goldman Sachs just reaffirmed their $5,400 target for gold. Bank of America just raised their forecast to $6,000. And JP Morgan, the bank that supposedly knows everything, just put out a call for $6,300 by the end of the year. These are not small names. These are not random bloggers with a newsletter. These are the institutions that move trillions of dollars. These are the banks that have access to data you and I will never see. And they are telling you right now in the middle of the panic that the bull market is not over. It is just getting started. Let me walk you through what just happened, because this is one of the most important signals you will see all year. Last week, gold hit an all-time high of $5,600 per ounce. It was a record. It was a moment of euphoria. The precious metals community was celebrating. The stackers were vindicated. And then Friday happened. Kevin Warsh was nominated to be the next chairman of the Federal Reserve. The market interpreted this as hawkish. The market believed that interest rates would stay higher for longer, and gold, which does not pay interest, suddenly looked less attractive. The selling began. Gold dropped 10% in a single day. It was the worst day for gold in over a decade. Silver crashed 30%. It was the worst day for silver since 1980. The panic was real. The fear was palpable. And on Monday, the bleeding continued. Gold fell another 5%. It touched a low of $4,403. That was a total drop of 21% from the peak, over $1,000, gone. In 2 days, the forums were filled with despair. The talking heads on television were declaring the bull market dead. The narrative was clear. It is over. The bubble popped. Get out while you still can. And then, in the middle of this chaos, Goldman Sachs published a research note. They looked at the crash. They looked at the 21% drop. They looked at the panic. And they said, our forecast remains unchanged. We see gold reaching $5,400 by the end of 2026. We see significant upside risk to this target. Let me repeat that. Significant upside risk. They are not just sticking to their target. They are saying there is a good chance gold goes even higher. Bank of America went further. They published their own note saying they expect gold to hit $6,000 in the coming months. $6,000. That is 18% higher than where gold is trading right now. And JP Morgan, in a separate report, said they see gold hitting $6,300 by the end of the year. That is 24% upside from current levels. Now, you might be asking yourself, why would these banks be bullish after a 21% crash? Why would they double down when everyone else is running for the exits? Because they understand something that the retail crowd does not. They understand that the crash was not caused by a change in fundamentals. The crash was caused by a change in sentiment. And sentiment is temporary. Fundamentals are forever. Let me explain what I mean. Gold rallied from 3,000 to 5,600 because of two structural drivers that are not going away. Driver one is central bank buying. In 2025, central banks bought 863 tons of gold, a record. Goldman expects another 850 tons in 2026. Why? Because they are diversifying away from the dollar. They see debt spiraling out of control. They want assets that cannot be printed. This demand is accelerating. Driver two is private investor demand. For years, private investors have been underweight gold, overweight stocks and crypto, chasing the tech bubble. But as the Fed cuts rates, as the economy slows, as stocks look expensive, private investors will rotate into gold. They will buy ETFs. They will buy physical bars. This demand will push prices higher. Goldman Sachs explicitly says this in their research note. They say our forecast incorporates two drivers: central banks maintaining their recent pace of accumulation, and private investors stepping up gold ETF purchases as the Fed cuts rates. This is the thesis. And nothing that happened last week changed this thesis. Yes, Kevin Warsh is hawkish. Yes, he believes in higher interest rates. But even Warsh cannot keep rates high forever. Even Warsh cannot fight the economic reality that the United States is drowning in debt. The market is currently pricing in 2 rate cuts in 2026. 2 cuts. That means interest rates are going lower. And when interest rates go lower, gold goes higher. This is not speculation. This is basic economics. When the Fed cuts rates, the opportunity cost of holding gold decreases. When the Fed cuts rates, the dollar weakens. And when the dollar weakens, gold, which is priced in dollars, becomes more attractive. So the question is not whether gold will go higher. The question is how much higher. And that is where the bank targets become interesting. Goldman Sachs says $5,400. That implies a 6% gain from current levels. That is conservative. That is a baseline scenario. Bank of America says $6,000. That implies an 18% gain. That is more aggressive. That is a bull case scenario. JP Morgan says $6,300. That implies a 24% gain. That is the super bull case. But here's the key. All three banks are saying the same thing. They are all saying that the crash did not change the fundamentals. They are all saying that the correction was healthy. They are all saying that the bull market is intact. And they are putting their reputations on the line by publishing these forecasts in the middle of a panic. That takes conviction. That takes courage. That tells you that they have done the analysis and they believe in the thesis. Now let me address the elephant in the room. Some of you are probably thinking, but these are the same banks that manipulate the gold market. These are the same banks that have been shorting gold for years. Why should I trust them now? That is a fair question. And the answer is simple. These banks are not monolithic. They have different divisions. Their research division is separate from their trading division. The research division publishes forecasts based on fundamental analysis. The trading division makes bets based on short-term price movements. Sometimes these divisions disagree. Sometimes the research says buy while the trading desk is shorting. That is the nature of a large bank. But the research division has a reputation to protect. If they publish a forecast and it turns out to be wildly wrong, they lose credibility, they lose clients, they lose money. So when Goldman Sachs says $5,400, they are not making it up. They have a team of analysts who have built models. They have looked at the data. They have stress tested their assumptions. And they believe this is where gold is going. The same is true for Bank of America and JP Morgan. These are not random guesses. These are carefully constructed forecasts based on fundamental analysis. And the fact that all three banks are bullish, even after a 21% crash, tells you that the thesis is strong. Now let me talk about risks, because nothing is certain. There are scenarios where gold does not reach these targets. Risk one is if the Fed does not cut rates. If the economy stays strong, if inflation stays high, if Warsh keeps rates high, gold will struggle. Higher rates increase the opportunity cost of holding non-yielding assets. Risk two is if the dollar strengthens significantly. Gold is priced in dollars. When dollar goes up, gold goes down. If dollar rallies on flight to safety or Fed hawkishness, gold faces headwinds. Risk three is if the stock market crashes. In a true liquidity crisis, everything sells off. Gold, stocks, bonds, crypto. Everything goes down because investors need cash. We saw this in March 2020. Gold dropped from 1,800 to 1,200 in 2 weeks. These are the risks. But here's the key. None of these scenarios are likely. The Fed is going to cut rates. The economy is slowing. Debt levels are unsustainable. The dollar is weak. And even if stocks crash, gold will recover first because it is the ultimate safe haven. So the probability-weighted outcome is that gold goes higher. And that is what the banks are betting on. Now let me talk about silver, because silver follows gold. If gold goes to 6,000, where does silver go? Historical gold to silver ratio is around 70 to 1. If gold is 6,000 and ratio is 70, silver should be at 85. But silver is currently at 90. That means silver is ahead of where it should be. Some analysts say silver is overextended, but I argue the opposite. The ratio is compressing. In 2011, ratio went as low as 30 to 1. If ratio compresses to 30 and gold hits 6,000, silver would be at $200. 200, more than double where it is today. Why could silver outperform? Industrial demand. Silver is used in solar panels, electric vehicles, electronics, all growing industries. Solar alone is expected to consume 30% of global silver supply. That creates structural deficit. That creates upward pressure. So while gold is driven by central banks and investors, silver is driven by all that plus industrial demand. That makes silver more volatile, but also more explosive on the upside. So if you believe the bank forecasts for gold, you should be even more bullish on silver. Now let me talk about what you should do with this information. If you are sitting in cash, if you have been waiting on the sidelines, this is your signal. The biggest banks in the world are telling you that gold is going to $6,000. They are giving you a roadmap. They are giving you a target. Your job is to decide whether you believe them. If you believe them, then you should be buying gold here. You should be buying silver here. You should be scaling into positions before the next leg up. If you are already holding gold and silver, if you survived the crash, then congratulations. You passed the test. The banks are validating your thesis. They are telling you that you are right to hold. And now your job is to keep holding. Do not let the volatility shake you out. Do not let the next 10% correction scare you into selling. Because the target is not 5,000. The target is 6,000. The target is not 100. The target is 200. If you are a trader, if you are trying to time the entries and exits, then this is a dangerous game. The volatility is extreme. The swings are violent. You could get chopped up. But if you are an investor, if you are playing the long game, if you have a 3 to 6 month time horizon, then this crash was a gift. It gave you a chance to buy at 4,400. And even if you missed that, it is giving you a chance to buy at 5,000. Because 5,000 is cheap if the target is 6,000. Now let me address the counter-argument, because there are bears out there who disagree with the bank forecasts. There are analysts who think gold is going lower. There are analysts who think the crash is just beginning. The most famous bear is Marko Kolanovic at JP Morgan. He's calling for silver to go to $50. He thinks the speculative froth was too extreme. He thinks the correction has further to go. But notice that Kolanovic is talking about silver, not gold. And notice that he is talking about short-term pain, not long-term direction. Even the bears agree that the long-term thesis is bullish. Even the bears agree that central banks are buying. Even the bears agree that the debt levels are unsustainable. They just think that the market got ahead of itself. They just think that a bigger correction is needed before the next leg up. And maybe they are right. Maybe gold goes back to 4,500 before it goes to 6,000. Maybe silver goes back to 70 before it goes to 200. But does that change the thesis? Does that change the target? No, it just changes the path. And if you are a long-term investor, the path does not matter. The destination matters. So do not get distracted by the short-term noise. Do not get distracted by the daily volatility. Do not get distracted by the talking heads who change their minds every week. Focus on the fundamentals. Focus on the banks. Focus on the targets. Goldman Sachs says 5,400. Bank of America says 6,000. JP Morgan says 6,300. These are not random numbers. These are carefully constructed forecasts from institutions that have access to more information than you or I will ever have. And they're all pointing in the same direction, up. The crash did not change the thesis. The crash was a positioning reset. The crash was a shakeout. The crash was healthy. And now, with the weak hands flushed out, with the leverage removed, with the sentiment reset, the market is ready for the next leg up. The banks see it. The smart money sees it. And if you are paying attention, you should see it too. This is not the end of the bull market. This is the middle. This is the part where fortunes are made. This is the part where the patient investors get rewarded and the panic sellers get left behind. So the question is, which side are you on? Are you going to listen to the noise? Or are you going to listen to the signal? Are you going to sell into the panic? Or are you going to buy the dip? Are you going to doubt the thesis? Or are you going to trust the banks that have been right for the last 2 years? The choice is yours. But the clock is ticking. Because once gold breaks through 5,500, once it takes out the old highs, the crowd will rush back in, the FOMO will return, the momentum will accelerate, and the opportunity to buy at 5,000 will be gone. So if you believe in the thesis, if you believe in the banks, if you believe in the fundamentals, then this is your moment. This is your chance. Do not waste it.